For years, Pennsylvania sold itself as the calm one in the room. Not flashy like California, not overheated like Florida, not chaotic like New York, just steady. Predictable. Safe. Families believed they could buy a home here without gambling their future. Investors believed the downside was limited. Longtime residents believed prices might slow, but never truly fall. That belief is now cracking. Not all at once, not with headlines screaming collapse. But quietly, the most dangerous way, markets change. Listings sitting longer, price cuts stacking on top of price cuts, buyers hesitating instead of rushing, sellers adjusting expectations month by month. Across Pennsylvania, home values are no longer climbing on hope alone. They are being pulled back by reality, local wages, aging houses, rising taxes, insurance costs, and a buyer pool that suddenly has options again. Some cities were hit first because they never fully recovered from their past. Others are feeling pain because they rose too far, too fast, on borrowed optimism. Today, we're breaking down 10 Pennsylvania cities where home values are slipping fastest, and where buying at the wrong moment could leave you locked into a shrinking market while everyone else quietly exits. This isn't panic, this is positioning. Let's begin. Number 10. York. York has always lived in the shadow of bigger neighbors, close enough to Harrisburg to feel connected, close enough to Baltimore to attract commuters, far enough away to remain overlooked for decades. That used to be its advantage. Homes were affordable. Neighborhoods were stable. Buyers who didn't need flash could stretch their budgets further here than almost anywhere else nearby. Then the housing surge arrived. Investors spotted solid brick homes selling for prices that barely covered renovation budgets elsewhere. Out-of-area buyers arrived with cash, urgency, and expectations shaped by much hotter markets. Renovations accelerated. Multi-unit conversions multiplied. Asking prices crept upward, then jumped. But something critical never changed the local income base. York's job market did not transform overnight. Paychecks did not rise to match housing costs. When inflation tightened, household budgets and borrowing became more expensive, the gap was exposed fast. Now the signs are everywhere. Homes lingering well past initial listing windows, repeated price reductions instead of quick offers, buyers walking away after inspections revealed deeper issues. York's aging housing stock magnifies the problem. Many properties look charming on the surface, but hide outdated wiring, old plumbing, foundation concerns, and years of deferred maintenance. During the frenzy, those issues were ignored. Today, they are deal breakers. Insurance companies are also more cautious. Flood exposure, fire risk, and old construction materials push premiums higher. Combined with property taxes that feel heavy relative to wages, total monthly costs quickly exceed what many households can tolerate. York still has pockets of value. Street-by-street knowledge matters more than ever. Prices are drifting back toward what locals can actually afford, and anyone who bought near the top is feeling that correction unfold in real time. Number 9. Erie. On paper, Erie should be winning. Freshwater coastline, public beaches, sunsets over Lake Erie that rival anywhere in the country. Most cities would kill for that natural advantage. But housing markets don't run on scenery alone. For decades, Erie struggled with population decline, uneven employment, and neighborhoods that never fully stabilized. When the national housing surge arrived, a wave of optimism followed. Buyers saw low prices, lake views, and the promise of a long-delayed rebound. Some areas did improve. Some renovations did succeed. But the recovery was never uniform. Now the softness is undeniable. Renovated pockets near downtown are holding up better, but even there, sellers are meeting resistance. Step outside those areas, and the weakness accelerates. Price cuts that start small often turn into reductions of $10,000, $15,000, even $20,000 once reality sets in. Erie's climate compounds the issue. Long winters mean higher heating bills. Freeze-thaw cycles punish foundations and roofs. Basements battle moisture year after year. Buyers who stretched financially are discovering how fast one major repair can destabilize their budgets. Those pressures feed distressed listings, which drag surrounding prices lower. The rental market offers little relief. Local incomes cap what tenants can reasonably pay. Heating older buildings through winter months is expensive. Landlords are forced to choose between costly upgrades or thinner margins, sometimes both. Erie will always have the lake, but natural beauty does not override economic limits. Right now, prices are adjusting to what the local economy can actually sustain, not what buyers hoped it might become. Number 8. Scranton. Scranton carries a reputation that often overshadows reality. For many, it's shorthand for industrial decline, closed factories, political talking points, cultural jokes. But the housing market here did move more than many expected. As prices climbed elsewhere, Scranton's low entry point attracted attention. First-time buyers saw a chance at ownership. Investors saw numbers that finally penciled out. A cautious sense of momentum took hold. Then, conditions tightened. Interest rates rose. Inflation squeezed necessities. Households that stretched found themselves exposed. By 2026, the signs are subtle but consistent. Listings staying active longer. Deals collapsing after financing falls apart. Price cuts shifting from occasional to expected. Scranton's housing stock adds friction. Many homes are oversized, inefficient, and costly to modernize. Electrical upgrades, insulation, heating systems, none of it is cheap. Investors who underestimated those costs are now holding stalled projects and vacant units. Those stalled properties ripple outward, affecting nearby values and buyer confidence. There are still areas where careful purchases make sense. But the idea that low prices alone guarantee safety has been dismantled. Values are sliding, especially where optimism once ran ahead of fundamentals. Number 7. Reading. Reading is a city that has lived through cycles. Manufacturing powerhouse, logistics hub, reinvention attempt after reinvention attempt. Housing followed each wave, rising, falling, stabilizing, then shifting again. In recent years, buyers from outside the region saw opportunity. Highway access, rail lines, and remote work flexibility made reading appear practical. Prices rose off historic lows, creating the sense that stability had finally arrived. That perception is now under strain. Listings sit longer. Price reductions arrive in steps. Foreclosures never fully disappeared and now feel more visible again. Local wages haven't kept pace with ownership costs. Property taxes, insurance, and maintenance erode affordability fast. Buyers are increasingly selective, and concerns about schools and safety weigh heavily on decisions. The result is a fractured market. Some neighborhoods hold value, others slide quickly. Investors face tighter appraisals, cautious lenders, and renters who simply cannot absorb increases. Deals that once looked marginal now tip into losses with one unexpected repair. Reading reminds us that affordability is relative. What looks cheap compared to coastal cities may still be expensive relative to local reality. Number 6. Lancaster. Lancaster built its reputation on balance. Historic streets, walkable neighborhoods, farmland just beyond city limits. For years, it was marketed as the perfect middle ground, affordable but healthy, charming but practical. Then attention arrived. Remote workers, long-distance commuters. Investors chasing the next safe market. Bidding wars followed. Protections were waived. Prices surged far beyond what local incomes could support. Now the disconnect is visible. Homes that once vanished in days linger for weeks. Price reductions arrive in noticeable chunks. Properties outside prime zones wait the longest, especially those needing serious work. Lancaster's older homes add risk. Beautiful exteriors often hide aging systems. Repairs cost more than expected, and many buyers are no longer willing to gamble. The rental market mirrors the slowdown. Tenants push back against increases. Even one vacancy can erase months of gains as taxes and insurance rise. Lancaster hasn't lost its charm, but buying here now means navigating a correction, not riding a wave. Number 5. Bethlehem. Bethlehem mastered reinvention, at least on the surface. Steel gave way to arts, tourism, and education. A walkable core, a respected university presence, and proximity to larger metros fueled optimism. That optimism became momentum. Out-of-state buyers arrived. Bidding wars followed. Student housing and short-term rentals multiplied. Now strain is showing. List prices no longer align with local wages. Homes sit longer. Buyers scrutinize noise, traffic, renovation needs, and location far more carefully. Tourism-driven demand is fragile. When discretionary spending tightens, festivals slow and rentals soften. Regulatory pressure on short-term rentals has also altered investor math. Bethlehem isn't collapsing, but it is recalibrating. The assumption that revitalization alone guarantees upward movement has been tested. Number 4. Harrisburg. The capital city carried an aura of stability, government jobs, legal work, a sense of permanence. During the boom, that reputation amplified demand. Development surged, prices climbed, Fear of missing out replaced caution. Now patience is required. Homes take longer to sell. Price reductions are routine. Buyers weigh flood exposure, insurance costs, and commuting expenses more carefully. Riverfront appeal comes with real risk. Suburban expansion relies on affordable transportation, something no longer guaranteed. Harrisburg isn't failing, it's adjusting. And that adjustment exposes anyone who assumed stability meant immunity. Number 3. Allentown. Allentown marketed itself as a comeback story, and for a time, the numbers supported it. New construction, downtown energy, investor enthusiasm. But momentum has limits. New units flooded the market. Rent incentives returned. Buyers became cautious. Neighborhood quality, schools, parking, and taxes now dominate conversations. Uneven revitalization matters. Buyers see it. Appraisers account for it. Allentown still has potential, but the margin for error has narrowed sharply. Number 2. Pittsburgh. Pittsburgh spent years redefining itself. Healthcare, education, technology. Investors believed it was permanently undervalued. Prices surged in trend-driven neighborhoods. Now those same areas lead the pullback. Maintenance costs, aging infrastructure, steep terrain, and capped rents are forcing recalibration. Buyers hesitate, sellers adjust. Pittsburgh remains strong but not immune. Number 1. Philadelphia. Philadelphia earns the top spot because it contains every pressure at once. Old homes, rising taxes, regulatory complexity, neighborhood-by-neighborhood volatility. Cheap money fueled expansion everywhere. That era is over. Homes sit, price cuts multiply, maintenance costs bite, quality of life concerns drive buyers outward. Small landlords quietly exit. Buyers grow selective. Philadelphia isn't fading, but it is bending. Across Pennsylvania, the pattern is clear. Prices outran paychecks. Optimism ignored aging reality. Now the reset has begun, not with crashes, but with patience, negotiation, and slow recalibration. For buyers, that means leverage. For sellers, realism. For investors, caution. The safest move now isn't speed. It's understanding the ground beneath your feet before it shifts again.